Yo, what's up you guys? Welcome back to another video. And in today's video I want to give you guys a usual weekly market update from a technical and a fundamental perspective. If you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoy the content, please do consider smashing that thumbs up for the YouTube algorithm, and let's try and get this video at least to 100 likes as a Christmas bonus for the channel. Now, without any further ado, let's just jump straight into the information. Now, if you are the kind of trader that looks at fundamental information, you would have known that last week was a complete landmine and it was impossible to basically even get into the markets. So if you just look at the news events that had taken place last week, if we go back over here, we can see that from the 12th up until the 16th, which was here, this was all the news events that basically took place last week. You didn't know if you were coming or if you were going. So if you were able to get into the market and made some profits, well done to you. But unfortunately, it wasn't the best times to trade, because it was quite a mixture of high impact data that came through there as well. It is important that I do update you guys on the situation currently on the dollar index, as it does look like the market momentum in terms of fundamental perspective had now shifted more bullish for the dollar index despite the 50% basis point interest rate hike that we received. Now I'll explain to you guys exactly why the bias has now shifted bullish, but we're on the back foot of a fear that a recession could take place there as well. Now, before we continue, it is important to understand that last week we had the CPI data, we had the federal funds rate, we also had retail sales and flash PMI data. Next week this week we only have the consumer confidence and the core PCE, as we are slowly moving into festive season, slowly moving towards Christmas and all of those days there as well. Now, without any further ado, my good friends, let's jump straight into the information. We can see this is an article by CNBC. It says here that Dow Jones closed more than 200 points lower, falls for a second week straight as recession fears grow, and which is basically what I touched base on now a couple of minutes ago. It says here stocks dropped Friday, building in year-end sell-off as fear grows over a recession that could potentially take place if the Feds continue to hike the interest rates. Now, I've been preaching on this channel a lot about interest rates. Now, on Thursday on Friday, I got a question from someone that said, if the Feds had hiked the interest rates at a 0.50 basis point, which is lower than anticipated, why did we see the dollar index, had this massive bull run, which is probably going to continue, not only to fill in that imbalance, as the SMC traders would say, but the market's more likely to continue this bullish momentum. And the reason for that is if you look at it from a different perspective, right? Although the Feds are hiking interest rates lower than anticipated, interest rates are still at an all-time high for the dollar index, thus making it still an attractive index or an attractive currency for investors to get their money into. It says here the Dow Jones dropped 0.85%, the S&P 500 was down 1.11%, and the Nasdaq 100 was down 0.97% there as well. Moving over, we can see here, it says here the Federal Reserve raises interest rates at a half a basis point to the highest level that it's ever been in 15 years. It says here the Feds had continued its battle against inflation by raising its benchmark interest rate to the highest level in 15 years. Now, it's always been the question about if the Feds go and hike interest rates lower, and this is something we saw with the GBP, where they came through and they hiked interest rate lower than anticipated. GBP gave up some of their value, and we saw, currency pairs trading against the GBP actually getting stronger. But the dollar index, on the other hand, we saw growing actually exponentially in terms of the value. And it made me realize it's time that I go and have a look and understand why this is taking place. And what I realized is that the dollar index at the moment went from 4.25% to now sitting at a 4.5%. As we can see here, it says the Fed's Open Market Committee voted to boost the overnight borrowing rate at a 0.5% basis point, taking the targeted range between 4.25 to about 4.5%. So why did it increase in value if we expected it to continue lower? This is why. Because because they're still adding to the dollar, because they're still hiking interest rates. This means the interest rates is still increasing in value, which is still going to negatively impact a consumer. If your debt was $1,000 last month or $1,000 last month, and they hike interest rates at a 0.50 basis point, that doesn't mean that your interest rate or your debt will decrease. It just means that your debt will now increase at a 0.50 basis point interest rates attached to it. Now the main question on everyone's lips now would be, so when do we know the dollar is going to weaken? This is when we know it's going to happen, and this is something I had to go and do research on, because I was the person who said if the Feds come through and raise interest rates at a lower basis point, we're going to see a weaker dollar. But then I had to go and do the research, and today I can tell you guys, but because the overall interest rates is still inclining or increasing, the dollar index is going to increase it's going to continue being bullish, and we can expect the dollar index to increase in value based on the information that we have now. So unless the Feds come and they cut interest rates, then we will see the dollar index decreasing in value, because a 0.50 basis point or 0.25 basis point doesn't make it any easy on consumers there as well. It says here, along with an increase came an indication that officials expect to keep rates higher throughout next year with no reduction until 2024. That is exactly what you want to kind of be looking out for. What this tells us is that we can definitely expect a bullish dollar index going into next year, and we can expect the stock market to continue lower into next year as well. And the reason for this is if the Fed continue to hike interest rates, even if it's 0.25 or 0.50 basis point, this means consumer debt will continuously be increased at that rate. The interest rate will increase, which the central bank would then pass on to the to the person that's borrowing it, then increasing their debt, making them which ultimately sends inflation down, because the consumer spending index is an indicator that is used to measure inflation. Inflation drops and the Fed can start looking at lower interest rates. So something that you can take away from this is that even if the Feds hike interest rates at a 0.50 or 0.25, as long as the interest rate is on a rise, the dollar index is going to increase in value. And that's something that I had to go and learn. And today I can say it positively with you guys. It says here, the Feds on Wednesday raised its benchmark rates to the highest level that it's been in 15 years, indicating that they're fighting inflation and it's far from over, despite some of the signs that we saw earlier with the previous CPI and the one before that, we saw it started to decrease there as well. It says here, keeping in the expectation rate setting Federal Open Committee voted to boost the overnight rates, taking the targeted range from a 4.25 to a 4.5. The increase broke a string of 4 3/4 point hikes, the most aggressive policy move since the early 1980s. Now, the fundamental data lines up perfectly with the technical data as well. Why? Because what we can see over here is, firstly, we had a market that broke above a strong level of resistance. The market then came back, tested it as support. From here, we can definitely expect a continuation to the upside. Now, we had this massive impulse. So after an impulse, you expect a correction. And if you take your Fibonacci from the low to the high, you can see that the market is currently testing the 0.786, which is the last Fibonacci level. The break below this level will then signal a bearish continuation to the downside. Now, on the weekly time frame, we can see here again the dollar index printed an equal low, and we can obviously see that support had held strongly. Apart from that, if you look slightly higher, you can also see how the dollar index had broken back above this structural level that we had over here as well. Now, here on the daily time frame, what do we see? Now, from a daily perspective, we can clearly see that this was the level that I anticipated the market to reject it from. And because the market broke above that level, I was thinking, well, what is happening? I had to go do the research, which I've said with you guys. We have the strong level of support. Market broke below support, came back to test it as resistance. Resistance did not hold. Now, what I expect the market to do going into not even going into next week. But moving forward is basically, I do expect, because we had this strong level of support that got broken, that was the resistance, the market broke above this level of resistance. All of that resistance is now turned support. I do expect the market to continue higher, create an equal low, pull back, then come back to test this previous level of resistance as support. In doing so, will the market also print an inverted head and shoulders pattern, which is considered a bullish pattern from a technical perspective. If you take your Fibonacci from the low to the high, anticipating that impulse, correction and impulse, we can see that we will have a 0.382 pullback, which is an indication that the market momentum is quite bullish should we get that level rejected. Next up, we have the Nasdaq. Now, based off the last breakdown that I did, I was expecting a bullish dollar index, and basically we're going to go through all of these that I have to correct, as I said here as well. So we had at least gold made some moves as anticipated, but again, the buyers on this has now completely sifted here as well, so I'm just need to redo this for you guys also. So first up, we're just going to continue with the Nasdaq. Now, firstly, what we have on the daily time frame, the Nasdaq printed this head and shoulders pattern, which is considered a bearish pattern from a technical perspective. Nasdaq just broke below strong level of support, and once support gets broken, it becomes resistance. We have this massive impulse. After an impulse, we anticipate a correction. The way to measure a correction is you take your Fibonacci from the high to the low, and we can see that we do have a 0.382 pullback, which is lining up perfectly with structure. If you look left over here, you can also see the market had printed strong resistance, broke above that, coming back to test it as support, giving us a clear indication that we can expect a correction going into next week, and then a continuation to the downside from the Nasdaq 100, as well as we also anticipate recession fears as it grows going into next week there as well. Next up, we've got the S&P 500, the Dow Jones printing similar price action over there. We can see the Dow Jones also broke below structure. We do expect a pullback and then a continuation there, as well as we expect the dollar index to increase, as the Fed has now indicated that they expect to continue hiking interest rates going into next week. Now, what do we have on gold? Now you can see that gold had printed an equal low. We had the market broke below that, grabbed some retail traders out there, but gold is now also printing what we potentially can see here, a head and shoulders pattern. Now, a head and shoulders pattern is considered a bearish pattern from a technical perspective. If you take your Fibonacci from the high to the low, what we have over here is we have this structural level over here that acted as a level of resistance. The market broke above that, tested it as support. Support did not hold. The market broke below support, printed an equal low, and we can definitely expect the market to continue higher, tested as resistance. We will also have the confluence of the 61.8, giving us a further indication that we can definitely expect this gold to continue the meltdown as we step into next week there, as well as we've got the confluence of the head and shoulders pattern from a technical perspective. We have the dollar increasing in value based off the interest rate hikes from a fundamental perspective, and we can also see that we have previous level of support that got broken that is now acting as a level of resistance apart from the 61.8 confluence there as well. Next up, we do have Euro USD. Now, Euro USD currently testing very important structure based off a price action perspective. We know this level of resistance gets broken, it come back, tested it as support. However, because we're anticipating a weaker Euro USD, we have to wait for a clear break below this level, a pullback, and then a continuation to the downside. We'll also see the same pattern that we identified on gold, which is a head and shoulders pattern, which is once again considered a bearish pattern from a technical perspective. Next up, we've got GBP USD as well. GBP USD printed an equal low. We can see this level acted as resistance. Mark broke above it, tested it as support, back to test it as support once again, printing an equal low. The market had also now created new structure over here. Now, this level over here acted as a level of resistance. The market broke above resistance, never came back to test it as support. Support never held. Now, once support gets broken, it becomes resistance once again. Now, we can see over here, we can definitely expect a slight pullback going into next week, and then a continuation to the downside. In doing so, will the market also print a head and shoulders pattern, which is considered a bearish pattern from a technical perspective. Now, that's all from my side. Thank you for your time, and as always, cheers for years.